Turkiye's central bank has raised interest rates for the first time in more than 2 years in a bid to cool double-digit inflation. The cost of borrowing money from the bank has gone up from 8.5% to 15%. That's an increase of 650 basis points. As in other countries, low-rate policies kept money cheap during the height of the pandemic. But newly appointed Finance Minister Mehmet Simsek says a return to higher rates is necessary in order to strengthen the Turkish lira, but also stabilise prices for imported goods. The central bank will have to balance the government's goal of driving economic growth with competitively priced Turkish exports, along with a need to ease inflationary pressures on consumers, which Ankara says it is top fiscal priority. For more on this now, let's go to Bilal Baish, economist in Istanbul. Thank you very much for joining us today. So what are the effects on the economy for what concerns inflation, but also for the rest of the economy?
Well, the potential negative real economic impacts, they will definitely be limited, and the market confidence, it will also be surely restored, although to a relatively limited extent, considering the amount of rate increases. This actually matters in particular for the financial and nominal volatilities that Turkey has suffered in the past few years. But as we see from the market reaction, it is also leading to stock market recovery as the main indexes are rising. Although the CDSs are also rising a little bit because the amount of rate increases, it was less than expected actually. The US dollar and euro, they have also had a slight upward trend, but not that significant so far. And this gradual incremental rate rise and more policy orthodoxy rather than the U-turn, it was actually expected indeed. Considering the recessionary effects in the US in 2022 and in Germany in 2023, the labor market and financial impacts of potential sharp rate rises, they probably are all taken into account. So in a way, it seems like the central bank, in a way, is letting the market adjust to this new era of orthodox policies, and considering the bond holdings of the banks, they were also effective in this rate decision.
Right.
And also the recession and labor market impacts, they will also probably be limited.
Right, and the statement has said that the tightening will be gradual, as you've just alluded to. But what does it mean in practice? And what's the impact on inflation going to be like?
So this gradual tightening, it was expected. This was actually the amount of rate increase. It was bare minimum to demonstrate the shift to orthodoxy to the market. It also means a rather balance between growth and inflation, as Turkey has opted for growth in the past few years, especially the past 1 year. And it's also a good sign of gradual return to rational policies, to the rational ground. And these gradual and incremental rate increases, as I mentioned earlier, it is in a way letting the market adjust to this new period of relatively higher interest rate, especially for financial markets, for the banking sector in Turkey. And the press release in particular, and also the latter Monetary Policy Committee summary that is expected, they will also be actually very, very important, as the press release, it has demonstrated that Turkey, it will be in a process of gradual rate rise process long after March 2021, after 27 months almost. And we will be having a new monetary tightening course that has just started. And the statement also has a relatively simpler language, and it focuses on domestic factors as opposed to the past statements that were focusing on external factors, international factors. And they also emphasize the impact analysis that are underlined in this new statement. In a way, they probably will be trying to understand the decisions' impact in the market before moving forward. But also, we could actually mention the case that it's interesting to see whether it will just be the interest rate channel that the Turkish central bank will be focusing on, or rather focusing on other instruments as well, such as the communication channel and management of expectations. And their signals, their announcements and statements, they will all be actually very major instruments to use in shaping policy efficiency looking forward.
Right, and we'll see what happens on that front, but surely a very important move. Bilal Bash, thank you very much. And now let's go to other top business stories from around the world. The Bank of England has also raised interest rates by 50 basis points to 5%. That's more than analysts expected. That says inflation in the UK remains stubbornly high at 7.1% in May. That's up from 6.8% in the previous month. Meanwhile, the UK's total government debt pile in May topped 100% of GDP for the first time since 1961. The US House of Representatives has approved an agreement aimed at deepening economic relations with Taiwan. Signed on June 1st, Taipei described the deal as the most comprehensive trade agreement signed with Washington since 1979. China had warned the US against signing any deal with Taiwan, which it claims as part of its territory. And the US Federal Trade Commission has accused Amazon of duping millions of customers into subscribing to their Amazon Prime service. The FTC claims Amazon used manipulative user interface to trick customers into automatically renewing their Prime subscriptions. Amazon says that these renewed subscriptions are because customers enjoy the service and that they make it simple for customers to cancel their memberships.